Hello, good morning everybody. Please take your seats. It's 9:06. We better get started because we have a long, intense day ahead of us. So my name is Marco Becht. I'm the Executive Director of ECGI. I just want to kick this off by putting today into context. So this is part of a two-day event. Yesterday was at the Milan Stock Exchange joint organization with Assonime, and it was about purpose and about families. That was no coincidence because, as you'll hear later on today, we have a new program on responsible capitalism, and we have three initial pillars of this, purpose and families, and today, on the second day, we have the third pillar, which is responsible investment. And the responsible investment pillar is led by Caroline Flammer, who's over here, and Rainer Gibson, who's over here. So they designed the program for this morning. So we'll start off, and I'll, after this, hand over to Marco Ventoruzzo, we'll welcome you on behalf of Bocconi. And then it goes to Caroline, who will introduce responsible investment, and then it's all go. So over to you, Marco.
Thank you very much. I'm a strong believer in unsubstantive and very quick welcome. So we are extraordinarily happy to have organized this. Yesterday was an interesting and to some extent also fun day. Today, as you can see, this room kind of reminds of an anatomical theater. So we will dissect more in details a few ideas, but we are truly glad to have you guys here. And in addition to all our speakers, friends, and participants, especially I want to thank the exceptional backstage team of ECGI, of Assonime, and of Bocconi, who has helped us in organizing practically the 2 days. Thank you very much. And now I think.
Thank you so much. All right, well, good morning, buongiorno. Let me start with, and just to state the obvious, we're in the midst of multiple crises. Climate change, biodiversity loss, social inequality, poverty. I mean, you can really pick your favorite crisis here. The typical response is, it's the government's role to step in and to regulate. Well, I agree. I'm also brainwashed as an economist, and it would be clearly the most efficient way to help address and mitigate these system-level challenges. But when we look outside of the window, which I don't think it exists in this room, but when you look outside of the window, you realize whatever the countries are doing, whatever the governments are doing, it's unfortunately not sufficient, because otherwise we would not be in the midst of these multiple crises. And so this puts the spotlight on the private sector, on the real economy, as well as the financial sector, to help mitigate these system-level challenges. Now, when you look at the current practices, corporate sustainable business practices, ESG practices, etc., it's exciting to see there's more and more actions and words around sustainable business practices. But you also notice that our thinking, our frameworks, our theories, our practices are very much confined to the firm level as well as at the portfolio level. What do I mean by, or what do we mean by that? If you think about, let's take the real economy, and there's a lot of conversation about the potential making it mandatory to disclose non-financial information such as Scope 1, Scope 2, Scope 3. Now, if we were to mandate Scope 1 and Scope 2, but not Scope 3, it would already be major progress compared to the status quo. Major progress. But, and there are some folks who say Scope 3 should not be mandatory because on one hand it's not under the immediate control of the focal firm, and it's very hard to assess. But if we were not to mandate Scope 3, what would likely happen is companies start divesting their most emission-intensive operations, Scope 1 becomes Scope 3, So on file, the companies look like they cleaned up their act, but nothing changes with respect to climate change because it's just outsourced their emissions to some suppliers. Similarly, if you look at, for example, diversity, equity, and inclusion, very important topic and issue, but the way it's practiced very often, and the way we research it very often, is we ask the question, how many women and minorities do you have on the board? How many women and minorities do you have in the top management? So what this likely leads to is a reshuffling of top talent from one top company to the other top company without really changing anything about social inclusion or social inequality. But all it does is it's reshuffling, but it does not allow greater access and social mobility. And let me make an example with the financial sector. There's a lot of pressure on investors to divest from emission-intensive operation or to divest from emission-intensive industries, for example. Now, if you truly care about mitigating climate change, divestment might not be the most effective way because all you do as an investor, you dump the shares, your portfolio looks like it's cleaned up, but you change nothing in the underlying sustainable business practices of the portfolio company you just divested from. Some other investor picks it up who might not care about the sustainable business practice of their company, correct? So potentially a more effective way of mitigating climate change and address other systemic challenges is not divestment per se, but rather to stay invested and to actively engage with your portfolio companies to change the practices. And the very last example I'm going to give in terms of the boundaries of our theories is modern portfolio theory. I'm not sure what is modern about it, but let's run with it. There's no such thing like hedging climate risks. If you think about it, you can't hedge climate risks. What you can do is you can hedge the portfolio risk against the temporary, the short-term climate risks, but it does not take into account the implications of your investments for climate change, nor does it take into account the increasing risks and costs of climate change on your portfolio's performance, okay? So we assume systemic risks to be exogenous in our models, not endogenous. So this is what we mean by our thinking, our frameworks, our theories, our practices are very much confined to the portfolio level and the firm level without really bridging to the system level. So there are two missing links. First of all, we need to take into account the risk exposure of companies and investments to these system level challenges and also the potential financial and non-financial returns, but also what are the implications of business practices and investments for these system level challenges. And the second link is, if you think about it, the way we have been trying to finance, for example, the transition to a just lower carbon economy, is a lot of it is done through public funding. What is important to close this financing gap that we experience is to use blended financing to help attract more private capital to get into the market to close that financing gap. Now, this is in practice already being done, but we have very little research about blended finance, for example. Okay? Second of all, when we look at about regulation, legislation, standard setting, etc., very often in our research we are thinking, given a set of rules and regulations, what's the ideal action for companies? What's the ideal strategy? What's the ideal investment? Assuming as if regulation, etc., is exogenous. We ask very few times the question, how can actually investors and companies be a positive force and positively engage with, let's say, policymakers to trigger systemic change? There is research on non-market strategy looking at the relationship between companies and governments, for example, but there again the focus is on what is the benefit to the company as opposed to how can we shape policies or how can companies and investors positively engage with policymakers in favor of, let's say, climate policy, in favor of LGBTQA policies, etc. So, what are some of the factors that are important in order to help address these systemic and system-level challenges. First of all, what we need is really the adoption of a systems-focused approach where we consider what is the impact of these system-level challenges on business and investment practices, but also what is the implication of our investment and business practices for these system-level challenges. We also need to develop better metrics that help us track progress towards the mitigation of these system-level challenges. The current frameworks that we have don't get at this. And last but not least, conduct more research and to gain a better understanding how to create effective private-public partnerships to help finance this gap, okay? And so this is precisely where this program comes in. I'm not going to talk about the initiative that we've launched at Columbia, but about the Responsible Investing program here at ECGI. We precisely want to foster and incentivize research that help us bridge that gap between the system level and the investment level. Understand what is greenwashing, what is just a benefit to the company, and what is actually the real impact on the real world. And with this, I'm delighted to introduce the program for today, or at least the morning sessions. So we've created a couple of sessions with excellent papers that are trying to get at this and also try to understand what are the boundaries potentially of ESG. Okay? All right, and with that said, I think I used up my minutes. Who am I handing it over to? I think Giovanni. Great, thank you.
Thank you very much. So let me just say welcome to everybody. It's a great pleasure to be here. It was also a great pleasure to jointly organize this conference with Assonime and ECGI. We hope that this is just the first of long series of jointly organized event, or maybe also in the next future. So we have, as Caroline said, the first session, a great session to start this second day of our conference. We have two papers. The first one is I would say great paper because I read it by Jill Fisch, Quinn Curtis, and Adriana Robertson. Today Jill and Quinn will present the paper and Guido Ferrarini will discuss it. Then we will have around 10 minutes for Q&A, so you just raise your hand and we can have a lively discussion, I hope. So the paper has a crystal clear title because it asks a question that is a key question: do ESG mutual funds deliver on their promises? Many scholars are striving to answer this question, and we have a great answer, I think, in this paper, and also encouraging. But I leave the floor to you. I don't know who goes first.
Yeah, there are some.
Yes.
Since I can't turn around and talk, let me just pull them up so that I can see what we're doing too. It's a great pleasure to be here. Thank you. And I'm going to try and set the stage on this work. I can't do it this way. And we've got limited time, so I'm going to whip through the background really quickly. But we're going to try and sort of flag some of the limitations on this work since we actually did the empirical analysis several years ago. Quinn's going to talk briefly about the empirics, and then we're going to try and flag a couple of, that's much better, thank you, a couple of policy considerations for discussion. So background, and you've been hearing about this since yesterday, right? An exploding interest in and market for ESG, and obviously ESG mutual funds are a big component of that market because at least in the United States, that's the way a lot of money gets funneled into ESG directly from retail investors, right? Here in the EU, situation's a little bit different, but you still have institutional investors of one type or another, and they're still driving the market. So a lot of what we say, I think, has much broader implications, although you will see it's a very US-oriented paper. Little bit in terms of statistics, and again, I'm going to go through this really quickly, but an increase until very recently every year on the number of assets, the amount of assets invested in sustainable funds, and an increase as well in the number of sustainable fund launches. And Elizabeth, who's done a fair amount of work in this area, is sitting there and thinking, okay, you're using the term ESG, you're using the term sustainability, be a little bit more precise, right? I'll get to that, but she's got a wonderful working paper that really sort of takes that issue apart. So the two concerns that have been brewing for several years, they continue to be important, and we take sort of a very early stage crack at exploring them in this paper, are number one, what are investors getting? If people invest in an ESG mutual fund, what do they get for their ESG dollars? And number two, what are investors giving up? And giving up, obviously, in terms of things like higher fees, lower returns, and greater risk. And lately in the United States in particular, it's great you come to Europe and everybody's on the same page with respect to sustainable investing, at least everybody that shows up at ECGI programs. But in the United States, it's a little bit more controversial and it's also a little bit more politicized right now. So from the left, we see greenwashing challenges. Oh, you have all of these ESG funds and they're not really ESG, or they're not really ESG enough. And from the right, you say, well, ESG funds are hurting economic returns and hurting retirees and so forth. And public pension funds in particular are caught in the middle of this debate. So ESG is also a major focus of regulators. So that's our current SEC chair, Gary Gensler, who has passed a slew of rules that I'll flag briefly. And one of his concerns, of course, is not just greenwashing, but information for investors. Can investors understand what ESG is based on whatever it is that these funds disclose? Right? So critiques of ESG investing, and I've kind of already flagged this, but from an economic perspective, right, there's a lot of literature suggesting, you might have a problem if you screen based on ESG because you're reducing the diversification of a portfolio, and you're also devoting greater management time to determining what is looking at portfolio companies, so that might be costlier. So regulatory developments very quickly. The SEC has a highly publicized proposed rule requiring portfolio companies to make certain disclosures with respect to their climate risk. We can talk either in the Q&A or at the coffee break about what we expect to happen with respect to that rule. But obviously, and the EU has sort of predated that with increased climate-related or environmental disclosure for companies. And obviously, if you're going to focus on funds, funds have to be able to figure out how they're investing. So that disclosure, I think, is a sort of necessary prerequisite. Then in May, the SEC proposed two more rules. One has to do with fund names, and the other has to do with the obligations of investment advisors. Both are designed to make sure that a fund name accurately conveys the extent to which a fund has some sort of ESG strategy, and two, that the investment advisor carries through on the investment strategy that they purport to be engaged in. At the same time, we've got the Department of Labor, which has kind of flip-flopped depending on the politics of the administration, between thinking, gee, ESG is problematic for some of the reasons that I talked about, and now actually proposing, gee, we want pension trustees to do more in terms of considering ESG issues. There are also a bunch of congressional initiatives that I don't have time to talk about. So what did we do? Right, briefly, and again, Quinn is going to talk about the methodology, but we looked at the very simple question: do ESG funds differ from non-ESG funds? And we'll talk about how we distinguish between the two along these four different dimensions, right? And what we found is, number one, they are different, or they were different at the time that we looked at the data, right? If you bought into an ESG fund, by and large, you've got something that seemed to be more ESG. And we also didn't find any evidence that ESG funds cost more or underperformed non-ESG funds. A few caveats, a lot of caveats. This is like when we have advertising for prescription pharmaceuticals, right? There's a long list of caveats at the end of the ad. These are the caveats. What is ESG? Elizabeth, I told you I'd get back to you. Right? Reasonable people can disagree, not just about what we mean by ESG, but what actually is an ESG company, right? Tesla's the company that always comes to mind. Great that they're making electric cars, bad on a bunch of governance and employee rights issues, right? So, who can say? Plus ESG, right, in Europe, you're focused mostly on environmental, And environmental in some ways is a little bit easier if we're looking at carbon emissions, if we're looking at recycling, right? But when you start talking about the S and the G and you lump a bunch of stuff in there, and then everybody's view about ESG is different, right? Can private prisons be like pro-ESG? And if they have a racial equity report, does that make them pro-ESG? There's actually a controversy going on about that right now. We don't adopt our own definition. We look at ESG ratings providers, right? So that's hard work. We commend that work to those who want to do it. That might be work for us in the future, but we don't adopt that definition here. What is an ESG strategy? Also hard. Are we talking about selecting portfolio companies that are ESG friendly? Are we talking about, and Caroline's absolutely right, to focus on impact? Well, are we trying to impact the world? So looking at companies that have a measurable impact on sustainability in the world? Are we looking at investing in order to impact companies, right? Those are different things. There's also, other values funds. What counts as an ESG strategy? At the time we did this paper, we were kind of intrigued by the Catholic Values Fund, because Catholic values seem to be a kind of ESG strategy, but not the one that everybody thinks about. Since we did the paper, there have been a host of sort of right-wing ESG funds. Some people call them anti-ESG funds, but there's the God Bless America Fund that invests in products made by or companies that employ American workers. I mean, that's a worker strategy. That seems to fall within the S. So, definitionally, these things are hard. And then there's the criticism, right? We used ESG ratings. Ratings, they differ. The same company can get two widely different ratings. For purposes of this paper, as I said, we were agnostic. And what we did to address this problem is we got ratings from 4 different organizations. Right, so 4 different ratings providers. So, and those ratings providers, as we discussed in the paper, used very different methodologies. We also don't try to analyze, is it in ESG enough, right? What we're looking at is the difference between ESG and non-ESG funds. You could say all the ESG funds are just at that superficial level, and I'm dissatisfied, and that's a fair criticism, and we don't address it here. One more caveat, we focus at a specific moment in time. Right, there's been a huge growth since the time we did this paper. Funds continue to evolve, so there are changes even within the funds we looked at. There's, as I said, increasing fund variety. Non-ESG funds are increasingly considering ESG issues, right? This idea of ESG integration funds, this is also a component in what the SEC's rules look like. And finally, ESG market conditions, obviously there's a relationship between the two. If ESG for you means don't invest in oil and gas companies, then their performance is going to depend critically on how well oil and gas companies are doing in the world. The war in Ukraine, obviously things can affect that are outside the scope. So we're looking at a very limited time period. So, okay, hopefully I talked fast enough to save you some time.
Great, thank you. Okay, so thank you. I'm just going to talk briefly through the empirics here. And again, this is a snapshot of time. We're just trying to get a sense of the extent to which, if you elect into one of these ESG funds, are you getting something different than a conventional mutual fund? And we identify ESG funds through a couple different ways. One, we just look at the name of the fund. Does it contain language that suggests responsible investing, environmental, ESG right in the name? And we classify those as ESG funds. Morningstar, for a number of years, has produced a list of ESG funds. So we have Morningstar Identified Funds. And then Morningstar also puts together a list of what they call ESG consideration funds, that I think the SEC is now calling ESG integration funds, that somewhere indicate we consider ESG factors along other factors, not even necessarily suggesting that they consider them more than other factors, and often not saying how. Some of these funds, right, in the marketing materials highlight their responsibility, if not in the name. Some of these funds you really won't know unless you dug into the documents that this is doing anything different. But we do separately analyze those funds, and it is kind of a different group, right? These are not presenting themselves in a highly salient way in the name to investors as ESG funds. So We use ratings from 4 different providers: Sustainalytics, S&P, ISS, and then True Value Labs, which uses sort of a machine learning approach that's kind of different from the other 3. So again, and this is from 2018, 2019. This is when we have the ratings data, so it's a snapshot. Now a couple of years past, but there's been a lot of discussion that these ratings aren't highly correlated. We sort of confirm that. What's interesting is we get relatively consistent results, regardless of which of the 4 ratings approaches we use, when everything's rolled up to the portfolio level. But again, we're taking those ratings as given and saying, are investors getting something different as measured by these ratings? And these ratings can be subject to reasonable criticism. So the first thing we ask empirically, the SEC's primary concern is, are investors being misled? Are these funds marketing themselves as giving you socially responsible investing and then not delivering on that particular promise? To get at that question, we take each of our ratings, basically take a weighted portfolio average for the ESG funds and the non-ESG funds. And here's the sort of histogram for each of the 4 ratings. And you see in each of those histograms a rightward shift for the ESG funds. So the first question is, are you getting a little bit more ESG in the ESG funds? And this suggests yes, regardless of which rating you use. Interestingly, if we look just at the sort of the left-hand outliers, the non-ESG ESG funds, they're not the same for each rating. So there are very, very few funds that across all 4 kind of look bad as ESG funds, suggesting that each of these funds seems to be, well, at least with respect to one rating, giving you some enhanced ESG value. So the first question, are you getting something as measured by these ratings? And the answer seems to be yes, with the caveat that Bill already highlighted, that we can't tell you that this is enough, because we don't know what you expect, what you think is reasonable, and it's a fair criticism of these funds. There's still quite a bit of overlap on those histograms. So this is giving you something. It's something measurable, statistically significant. It's not surprising that it comes out in the regressions as well. But is it enough? That's sort of a normative question that we just have to bracket for the purposes of this paper. The next thing we looked at is, do these funds vote differently? And this is kind of interesting, because I think most people would expect if you invest in an ESG fund that's generally going to support ESG initiatives. But I don't think that they make a lot of strong claims about this. They'll talk about their stewardship. And I'm not sure, that a lot of investors, retail investors in the ESG funds, even think a lot about the voting aspect of these funds. Nevertheless, I think it's interesting to look back and look at, and they've certainly been criticized in the past for not sort of walking the walk in the respect of their shareholder voting. So what we looked at is the sort of propensity of these funds to oppose management on shareholder proposals, which are almost all ESG salient, and then unopposed director elections. Just sort of an interesting side question: are these funds sort of more independent of management in unopposed director elections? And we found that the answer in both cases seems to be yes. They're more likely to support shareholder proposals over management objections. They're more likely to vote against unopposed directors. And to sort of narrow in on the sort of easiest one to classify, we found that environmental, the E funds that sort of foreground that, are particularly likely to support environmental proposals. So you see, again, some difference, enough, hard to say. Let's see, when I click, it doesn't actually move it on my phone. But again, some measurable difference in the voting performance of these funds. The next thing we looked at is performance. And we're honestly a little reluctant to undertake this because we do have this relatively narrow window. There's a big literature in finance on the performance of these funds. A lot of these funds are new. They don't have a big performance track record. You can't do a fancy factor model because you've got such a short window of return, so we're just doing kappa and betas here. But it was a question we were going to get, and so we decided to go ahead and measure it. And what we found was no evidence of underperformance. For some of the funds, we actually get the Morningstar consideration funds, the integration funds, got a little bit of overperformance. We're not going to put a lot of weight on that. And again, right, post the publication of this paper, performance trends for ESG look different. That doesn't necessarily falsify the ESG investment hypothesis. But at the time, a lot of these discussions were going on in the DOL. They were making strong claims about the negative performance aspects of ESG, and we just didn't see that in the data, subject to the short-term limitations of what we're measuring. The other concern that comes up is the. Did I give you the?
Yeah, the fee slide is before the performance
Sorry,
slide.
no, it's just parts. Okay, so
Can you see it here?
What's that?
Can you see it on this? I tried to turn it towards you.
Yeah, it's okay. So performance-wise, so here's expense ratios. I apologize for getting that out of order. What we found for the expense ratios is that these funds, and this actually was not our prior, that once you control for is it an index fund and what's the investment style, you're not really paying more for these ESG funds, at least with the subset of mutual funds that we identify. And again, this sort of contradicted the DOL's concern that people are overpaying for these funds. We didn't find this statistically significant price difference, except with the Morningstar consideration funds, which are, again, not really strongly marketed as ESG funds. So to sort of summarize the empirics here, what we got was funds that are giving you some shift in the direction of higher ESG as measured by the ratings, some shift in the direction of more ESG as measured by voting, not particularly more expensive, and not at a higher, and not at least in the short term cost performance. And so, our takeaway was that the sort of wave of regulation targeting these funds might have been unnecessary. That a lot of the issues, right? Well, what are these funds doing? What does ESG mean in this context that this regulation is targeting? Are questions you could ask of other types of mutual funds. It's hard to say what a growth stock is. What does a growth fund do? What is a value fund, right? These are very conventional ways of marketing mutual funds. Surely investors could use a little bit more clarity on those very conventional mutual fund styles. I don't have any objection to that. But ESG is a lot like that, right? It's another way of investing, another style. And the notion that it needs to be singled out for special intervention just didn't seem well supported in the data. So our sort of takeaway, there's no obvious reason to discourage ESG considerations as the DOL was looking at doing by pension fund trustees. There's no obvious reason to discourage the use of these funds in retirement plans. But, the pendulum has swung the other way with the Biden administration. There's no obvious reason to require these requirements. None of this jumps out as showing that this is clearly an effective investment strategy either. So our takeaway is there doesn't seem to be a huge problem here. Perhaps more transparency about these strategies as the SEC is looking at would be helpful. But at the same time, that might well be true of lots of other ways of running mutual funds as well.
Thank you very much for your presentation. The floor is immediately to Guido.
They should put it up so you'll see it on here eventually.
Yes, it will appear here.
The slides will appear there.
So, first of all, thank you very much for inviting me here. It's great to be here and celebrate the 20 years since the foundation of our institute. We were at that time a very small group of people meeting, as Marco said, under a staircase, more or less. And now it's a global institution, thanks to Marco and to other people who have worked over it. So it's quite emotional to be here and celebrate this event. The paper also is great. Let me see. Yes, I have prepared some slides, but the recommendation is to be short, to leave time for discussion. So I adopted the European perspective, which is for me a comfort zone, to assess this great paper written by authors who are great experts both in law and economics and statistics. So it's quite amazing as a paper. My main question will be, what does it teach to us as European? As you heard already, their final proposals in policy terms are quite, let's say, liberal. They say we don't need too much regulation, at least we don't need more regulation than we have already. Actually, my feeling is that you have already quite a number of rules which are good to enforce for this type of issues. But in Europe, no doubt, we are running a very different course under the lead of the European Commission. If you see here in this slide, 3 years ago, the European Commission launched the European Green Deal. We have an action plan which foresees many actions, including a classification system for sustainability activities. We don't speak in this field much of ESG, we mainly speak of sustainability. It is true, as Jill said, that we mainly mean environmental sustainability, but we start including also social sustainability. And then the action plan foresees amendment of asset managers' fiduciary duties, and this compares to the rules that you comment upon of the Department of Labor in the US and the SEC, etc. So what are the main pillars of this new field of regulation? First of all, we have this EU taxonomy regulation. I'm speaking here to our American colleagues because, of course, as we Europeans, we know it quite well. Taxonomy regulation, again, concerns only environmental sustainability, but it is foreseen that the regulation will be adopted also for social sustainability. And the regulation tries to harmonize criteria across Europe about the classification of sustainable activities. And this compares to what you comment in your paper, saying that we don't know exactly what ESG is. Of course, there are papers like Elizabeth's on the history of ESG, and this is very informative. But still, the taxonomy regulation aims to do something more. So they want to really define what is sustainability and all the subspecies of sustainability. And then we have this EU Sustainable Finance Disclosure Regulation, which is, I guess, a kind of nightmare for financial institutions in Europe. In Europe, not only asset managers, but also insurance companies, pension funds, and banks, investment firms, etc. So they are required to disclose information regarding their approaching to the integration of sustainability risks in the management of their assets. And here it is very interesting to read the paper, and the question arises, what are, from an American perspective, our funds, considering that all asset managers today, by law, are requested to integrate sustainability risks in asset management. Are they comparable to what Morningstar calls, what is it, ECG consideration funds? Are all our funds ECG consideration funds? No doubt ESG is considered by all asset managers, including insurance companies, etc. And then we have two rules in this disclosure regulation, which are very well known to Europeans, and these are really the basis for the classification of investment funds and other investments in Europe. Article 8 are those financial products that promote environmental or social characteristics, and Article 9 are financial products that have sustainable investments at their objectives. These are very vague formulas. They leave a lot of discretion in classification. The end result is that we have three types of ESG investments. The first one is, let's say, ESG consideration funds. Then we have Article 8, which is the largest category. These are more ambitious, but not like Article 9, which are the sort of impact funds and similar investments that we know are at the top also of Morningstar's classifications. So the impacting practice is important, even though there is, as I said, a lot of discretion. We are writing a paper which is already in draft about ESG stewardship in Europe. And if you read the disclosure of these asset managers, you find that each category encompasses types of investments which are very different one from the other. And then we have a lot of regulation now of fiduciary duties with respect to sustainability issues. For instance, the legislation concerning UCITS and alternative investments now includes an obligation to integrate sustainability risks in the management of portfolios. Something similar we find in insurance regulation. Investment firms are also required to classify the preferences of their clients, which is really a way of closing the circle. You start from the client and from its investment preferences, and then you should offer to clients investments which are suitable to that type of preferences. So the real question, considering your wonderful paper, is then is the regulation of ESG stewardship in Europe flawed? Did we adopt too many rules and too early? Probably. So the question which I suggest the paper addresses to the EU policymaker are, first of all, disclosure regulation is important, but isn't it too burdensome? In this field, we may be stricter than the US securities regulation. Can the market function with less mandated disclosure? And here we have a classical question. Luca has written much about it in securities regulation, and the same type of arguments apply here. Do we really need this type of mandated disclosure? And then your proposal and the question, are third-party information providers good substitutes for disclosure by financial market participants? are private ordering solutions better than public regulation? These are the challenges that this paper proposes to us all. So I leave room for the discussion. Thank you.
Thank you very much, Guido. Maybe Quinn and Jill want to react to the Guido comments, but maybe before we can open the floor to the question, there is already one question. Can you give the mic? Thank you very much.
Hi, I'm Stephen. Hi, I'm Stephen Davidoff Solomon from Berkeley and Jill's co-author, and also an American skeptic. So 2 technical points and 1 larger question. One on your voting and fees. I know you had fund complex fixed effects, but I think you might want to, it would be interesting to look within the fund itself. So is BlackRock offering an ESG product that they're charging more for than the other, the matched product? I mean, I think that's really the question, because this is an important paper, which you know, and maybe the audience doesn't, because the Department of Labor there's a debate whether you can even consider ESG or you have to just invest for profit among pension funds in the US, and this directly informs it. But I would be curious to know if, and also for voting, as you know, BlackRock sort of tends to vote across the way. And then there's a third technical point, which is I'd like to see active funds versus ETFs on sustainability versus non-sustainability. So I think, again, if BlackRock's offering a more expensive product for ESG, then people are paying for it because they only have BlackRock to invest in the US through their funds. So I think it'd be interesting to look at that. I think the second thing is, and again, this is a really important paper, thank you for it, is I am truly an American skeptic on this. You know, I think if we were in the 1970s, we'd be talking about overpopulation as a crisis and nuclear war, which I guess still is. And so I'm always skeptical of private choices versus allowing the public to do it and coming top down from elites. But I just pulled BlackRock's top ESG fund, and its top 5 holdings are, Jill, you want to guess? Microsoft, Apple, Alphabet, Amazon, Tesla. And so how do you approach this from the idea that these are just disguised tech funds and the tech companies are acting endogenously through, frankly, monopoly profits to put forth characteristics that you're investing for ESG, but you're really investing in tech. And so you could take all of your ESG funds, unwind their holdings, and look at what the returns are, right? And then match them up towards the individual holdings of the non-ESG funds. And that's really the question, right? And so I think now that we have the great unwind, you know, and I know you're a shot in time, how do you address your fact that you're saying they're not that different if in fact I am correct that these are just disguised tech funds?
We take a few questions and then maybe, you know.
Thanks. Tom Gosling, London Business School. Yeah, thanks a lot for the paper. I mean, it's one of those things where the differences in the funds were sort of statistically significant, but kind of not very big, in that, you know, the ESG-ness was kind of moving a decile, you know, up. And so I wondered whether you looked at anything in relation to looking at the extent of ESG-ness. So if instead of looking at just kind of ESG versus non-ESG, within the ESG categories, did you look at anything in terms of the ones that are kind of higher up on the score? So because there are some funds that are kind of saying they're ESG, but are just kind of closetly doing what the market does. So I just wondered whether you get any more trends if you kind of look at the more extreme ESG funds. And then on the difference around performance, I mean, one of the challenges around ESG funds would be if they're exposing people to significantly kind of different risks or portfolio constructions, and that may or may not play out in performance over a given period of time. So did you look at whether industry or factor exposures were materially different between the ESG and non-ESG funds? Is there anything you can say on that? Thank you.
Thank you. If I understood correctly, ESG and no-ESG fund are equivalent in terms of, on average, on costs, fees, and performances. So I would have one question. On the point of view of those setting up funds, why should they prefer setting up a ESG fund rather than non-ESG? So one answer could be reputation or personal beliefs, but do you think that we would need also legal intervention in order to more strongly economically support and help ESG funds rather than non-ESG funds?
What the question is, I didn't quite get that.
Since in economic terms, so on fees and performances, ESG and non-ESG look to be equivalent. So on the point of view of those setting up funds in their choice on strategies between ESG and non-ESG, why should they prefer and so go on ESG rather than non-ESG? One answer could be their personal beliefs, reputational terms in the market. But do you think that we would need also a legal intervention to economically support ESG? So to create more incentives for this decision on ESG rather than non-ESG? Thanks.
Yeah, so I mean, if you have a couple of answers on the empirical, and then I have just a couple of just global responses.
Yeah, I mean, so to David's question about trying to match on the fees within families, I think that's a nice suggestion, because an investment committee, I mean, surely at some point investment committees are in a position of having to choose between two relatively equivalent funds, one of which is better on an ESG scale and is maybe more expensive, right? What their fiduciary duties require of them at that point, I think is a question we can't answer empirically, right? That's got to be a question of how legally legitimate it is to bring these considerations in as an investment committee. So I think it's worth looking to see if systematically that's true across families. We, as you pointed out, looked at style and active or passive as our dummies in that regression. So in some sense, comparable funds, but maybe not exactly simulating the decision that investment committees might be faced with. And the question about, is there something interesting about the particularly high ESG funds? You know, we didn't explore that, but that I think is an interesting question. Yeah, like what's out in that right-hand tail? Is it associated with a particular family? It's like Calvert, a bunch of those funds or something. That would be interesting to look at, and I think might be worth exploring. So thanks for that suggestion.
Yeah, and I mean, keep in mind that we were doing this at a time, this is kind of early stage work in the empirical analysis of ESG investing, and the funds that we were looking at, some of those funds have changed their approach even from the time that we collected the data. So our concern was to do some statistical analysis of that moment in time, recognizing that it might inform both what funds do going forward and regulation. In terms of kind of, is it too much regulation? Well, there are two things going on that I didn't really talk about, but that are kind of behind this. One is this debate about whether ESG is about economic value or whether it's about values. And I haven't seen any empirics, that really can answer that question, at least to date. And when people talk about ESG investing, they're often sliding back and forth between the two. And I'm very sympathetic to what Marco said yesterday, that at some point, ESG investing seems to be about sacrificing economic value, right? Maybe there's a certain extent to which you're incorporating environmental risk because you think it affects the bottom line. But a lot of what people are asking companies to do is to go further. And so the question is, how does that play out in a world of intermediated investing? And a big problem that I have with funds and with some of the European initiatives is they don't really put for investors the fact that you might be making that choice. So the European suitability requirements don't say, do you want more sustainability and are you willing to pay for it? Right? And if they did that, maybe you might get a different answer in terms of client preferences. I can't remember what the other thing was, but we're out of time anyway.
So thank you very much to Curtis, Jill, and Guido for the great discussion and for the great start of the day. Now we have another interesting paper by Xiao Yang, and the discussant will be Jean-Stéphane Messonnier, that I asked to come here. So thank you very much. Thank you.